is meeting guided numbers across board becoming difficult? Let's pose that question to Maneesh Dangi, founder of Mosaic Investing and Research. And Maneesh, great having you as always. Thank you for taking the time out and being with us. You know, the question really, I mean, that I want to start off with is not about what individual earnings have looked like, but it does seem that earnings are depicting what the economy seems to be going through, which is a patch of sluggishness, of which coming out of is not becoming predictable. Management after management at the end of Q2 had said that H2 will be better than H1. We've seen only sporadic instances of strong results. By and large, it's been a tepid Q3.
Hey, good morning. So that's pretty much routine, right, Neeraj? You know, things go up and come down in economy and pretty much everything else that we've ever discussed. So we are in the midst of a cyclical slowdown in the economy, and you know, it's totally expected that relative to bullish expectations, you know, majority of things would be disappointing you. And there is a clear about 5-7 months back, you know, we were discussing about you know, potential slowdown in economy. That was a speculation, but it's very evident anywhere and everywhere you see in India and in its economy that, you know, things are slowing. And that's reflecting in last 2 quarters results. And, you know, this hope that, you know, these slowdowns last very short for 1 or 2 quarters that I hear from many people is, of course, incorrect. You know, typically 2 things happen. One, these slowdowns tend to sort of drag on for 5-7 quarters at least, if not more, and they never recover without a solid assistance from policy stimulus. So either a major fiscal or monetary stimulus is brought in, or some kind of an external support comes into economy, and that is only when sort of pace of deceleration slows and eventually things begin to recover. So in a sense, you know, the template of both slowdown and recovery is sort of fairly known and historical, and sort of recur again and again, and that is what I think should happen over next 1.5 years as well.
So Maneesh, can I ask you, in a scenario like this, and we'll get to nuances, but in a scenario like this, I'm just trying to think of the possible assistance that could come to the economy, because the government is on a guided glide path towards fisc deficit, and because the revenues haven't been that great this year relative to the past. If we assume that the government's hands are a bit tied, even if the capex spends haven't been high, is the mantle with the Reserve Bank to give out something? And therefore, does Feb 7th or Feb 8th in that sense become a lot more important in the near term than what Feb 1st does?
So I agree to it. You know, the government is tied to a variety of things. You know, one, of course, the consensus in the world is not to do further stimulus, fiscally, more importantly. Also, our public debt to GDP actually has not rolled down after the COVID stimulus. So to that extent, you know, our hands are tied. Along with, of course, there's sort of a general consensus in Delhi, if you meet people, that, you know, this FD has to be brought in as promised. So I totally agree to your view that the likelihood of a major fiscal splurge is sort of a very low probability. And therefore, of course, majority of weightlifting will have to be done by Mint Street, that is RBI, of course. Unfortunately, its hands are also tied to you know, what is happening in our currency. It's very sort of unlikely that an emerging market begin to cut rates when its currency, quote unquote, is being attacked. So, and you know, some sort of folks are writing, you know, to short INR for a variety of, you know, structural or cyclical reasons. And so to that extent, you know, an outright monetary easing, you know, is a difficult proposition from RBI standpoint. I think what should happen, of course, is what is happening outside of the policy, which is, you know, liquidity easing by way of, you know, variety of instruments, you know, at disposal with RBI. It's also, you know, it is sort of a soft regulatory unwind that is happening right now. You know, under the previous governor, the regulatory oversight and, of course, tightness had risen dramatically. I think a lot of those policies are being unwound both by, you know, a direct communication, but also soft communication to the participants. I think that should ease a little bit of a pressure. But again, if you are looking for something dramatic, in terms of rate ease, we are not in a living in that context right now. If you heard Fed, right, I mean, Powell has actually pretty much pivoted back to hawkishness, and that's not a regime, when actually you can actively and pursue a super light or super easy, rate policy, so to say.
Manish, hi, Tamanna here. I was going through your note and listening to what you've said in your response so far, and the picture, frankly, is quite bleak. We are in the slow lane. There's concern about jobs, the quality of jobs that we are putting together or creating. Household debt has spiked. All of that. But then I see this one line in your note which says, "But super pessimists have always been wrong on India." So my question to you is, what is the optimist's case for the India story right now?
The optimists look back in the past and conclude that anyone who's super bearish on India has always been wrong. I think the history is the best guide of actually predicting future. And to that extent, for 25, 30 years, and why 25, 30 years? Since the beginning of this country, everyone has been super bearish on India's both politics and economics. And I think we've proven them wrong collectively. It's a messy setup, the way we work. We really, of course, can't achieve what East Asia and China could achieve, but, to call India a failed state at times, and of course, a failed economy has always been wrong. We somehow chug along, we seem to deliver a 6% growth, irrespective of all the constraints that we face. So to that extent, of course, I make this argument, which everyone does, whoever is guided by the history, that super pessimists are always wrong. What's good in India, of course, it's a great demographics. Your labor population is still growing by 1%. Everything, from education to healthcare to infrastructure, steadily has been improving for not just 5, 10 years, but forever, for the last 30, 40 years. And all that means that, a lot of our, sort of labor stock, capital stock is will likely continue to sort of improve in terms of productivity. And that should sort of, over a long period of time, should deliver at 5, 6%. My quib always has been on the other side. And, these, so-called, super bullish wallas that, who argue for every 5, 7 years, once people forget about the real thing, that, the super bullishness of, India's sectionalism and stuff like that, of course, they've been wrong and they take people for a ride. So that's also wrong. So in a sense, the truth is somewhere in the middle as far as India is concerned, that it's okay. We're going to go at 5.5%, 6%, most probably over like next 5, 10 years. Also, it is important to recognize that while the big picture growth is 5.5 or 6% is absolutely all right, but in near term, we're going to have a cyclical slowdown. And to that extent, once you sort of contextualize vis-a-vis the market valuations and expectations of investors, you might get a root shock there.
You know, Manish, I'm just wondering how you're looking at the slew of corporate results which have come in third quarter. And I half suspect you'll say that this was expected, but this was worse than expected, isn't it?
I mean, see, listen, Tamanna, as a matter of fact, isn't it surprising that, we're in the midst of a slowdown? Last, growth print was in 5 handle when, a year ago we entered with 8 handle. And yet, the margins actually, until about 2 quarters ago, were actually super elevated relative to any time since GFC. So frankly, there's a big moolah, for corporates have been absolutely making phenomenal profit margins. And so therefore, I believe in rotation, I believe in cyclicality, and it's very, very difficult to imagine that, profit margins would stay as elevated as they are, when the revenue growth is and the GDP growth, nominal growth is so sluggish. So, I think one of the brokerage report puts out this beautiful chart where it actually argues that how the corporate margins sort of has steadily gone up for last couple of, and I do mention that in my report also, that have gone up, despite revenue growth has been sort of steady and sluggish. So to that extent, I think this rollover is totally expected. The thing about once educated by history is that you never can time future very well, but moti you sort of know the direction of it. And I think this is a little bit of an inflammation in corporate margin in the context of sluggish revenue growth is certainly something which is kind of an odd man out and should mean revert, is how I would think for next 1.5 year.
Manish, my final question, I'm just trying to mix some of the things that you've spoken today with what eventually the market likes, which is a slave to earnings. And because the market is comprising of the top 50 companies, who presumably are the most efficient of the lot, even if the wider economy may not grow at the pace that is desirable, can earnings growth still belie what is the common reality on the ground, and therefore ensure that the headline indices stay okay? Okay, I think I think Maneesh got a call, if I'm not wrong, and maybe that's why this just got a bit mixed. But okay, Maneesh, if you're here, yeah, just wondering if earnings growth can belie what the larger sluggishness on the ground might be because of some of the factors, including what you said, right? Yes, the margins may mean revert, but they may stay higher for a bit longer.
I mean, of course, certainly happen. You sort of look west, and in US top five economies, Nvidia, Meta, Alphabet, Amazon. They've actually the earnings have grown at 45-50% CAGR for last 2 years, even when economy was so-called growing at just about 2%. Rest of S&P 500, actually, those 495 companies earning growth was just 2-3%. So if you're saying that if something like that can happen in India, purely from the point of view of does it happen ever? Yes, it can, and to that extent, answer to that is yes. Then you could look for questions and answers to the question as to why. In US, you could argue those 5 or 7 companies did so remarkably well because of the productivity growth, the new terrains that they're actually charting. Is that something similar to happening in India? Is there a sort of pocket where the productivity boom at margin at play? Could you imagine something that someone has come up with some new tech that essentially helps you produce something that you were otherwise producing for $100 but now 90, and therefore the margins would expand at margin? It did happen by the way post-COVID, and that led to a massive margin expansion, and therefore the earning growth of 18-19%, even when the revenue growth was just 10%. It's just that that pocket doesn't seem emergent at any point in any other place right now. I think on the other side, what we see is that banks, though better priced today, but are struggling because at margin the source of rapid credit growth there are actually slowing, which is household credit or the retail credit. That's a significant part of what do you call indices. Manufacturing, especially tradable one, are right now or are likely to fail major deflationary pressures if US were to erect tariffs. Imagine if US were to have a 20% tariff on anything that it imports from China. China would flood the world, including India. Those wares will actually come to us. And would create massive deflationary pressure. So to that extent, it is not in a macro setup like this. We can imagine a new wave of margin expansion without a technological breakthrough. A frontier economy, Neeraj, and I don't see any major technological breakthrough apart from just one area which I've been bullish on, which is IT. I think we are sort of very well plugged into US tech, at least, and I think our firms are agile. They've reinvented themselves over and over again. And I think we would be great beneficiary of this AI robotics arms race, which is playing out between US and China. There are going to be lot of collateral damages in India, especially in India manufacturing. But I think IT services would actually do exceptionally well. So within India, if I go to pick up where there could be a unleashing of a new productivity gain, so to say, I think I would sort of bet on Indian IT, not too many other places.